This is FRM Part 1, Book 3, Financial Markets and Products, Chapter 1, Banks. I always like to give my students the definition of a bank that I learned back when I was working on my MS degree. And my professor wrote on the board, a bank, a financial institution that accepts deposits and makes loans. And that's what I remember about banks. And so we're talking about financial markets and financial products inside of this banking industry. And so if you think about just really that basic definition of banks, has an institution, it's got a balance sheet, so it accepts deposits, and then it makes loans. So those deposits are all its liabilities, and then it makes loans. Those are all its assets. Oh, what could go wrong in a financial institution? So let's look at these learning objectives here. Notice that first one. This is really cool. Identify the major risks faced by a bank, and then distinguish between stuff that goes on the bottom right-hand side of the balance sheet from an economic perspective, and then stuff that the government's interested in. So we're going to distinguish between economic and regulatory capital. We're going to explain the moral hazard. We're going to talk about raising capital, private placement, public offerings, and then one of my favorite things out there, a Dutch auction. We'll describe conflicts of interest, talk about the banking and the trading books, and then explain the originate-to-distribute model. So let's go ahead and identify those major risks faced by a bank. And these are probably not new to you. This is stuff that you probably learned in your undergraduate days and clearly in your studies for this FRM exam. So let's talk about these, just pretty quickly. Credit risk, the risk that borrowers will fail to meet their obligations. So remember, what does a bank do? It makes loans. It makes loans to people like homeowners, automobile owners, personal loans. I mean, any kind of a loan that's out there, small business loans, or even large business loans. Now remember, when those borrowers come into the financial institution, the idea is that they're going to provide evidence that the loan can be repaid. So credit risk is the risk associated with those borrowers not making timely and full amount of the interest and principal payments in accordance with those agreed terms. Market risk, on the other hand, is something completely different. This is the risk of losses of a bank's trading book due to all of these market factors. So remember, what financial institutions can do is that they can take some of those depositors' capital, and they can do whatever they want with them. I mean, not really do whatever they want with them, but they can do stuff that we can do with them as well as individuals. They can invest in stocks or bonds or foreign currencies or gold and silver or peaches and strawberries. So they can invest in all different sorts of things. So market risk is the risk that the value of those investments will fall because of things that are going on in other markets. For example, in the United States and throughout the world, these last couple of weeks, really been an emphasis on the U.S. Trade policy with China. And so sometimes stock prices are up and sometimes stock prices are down. And of course, this happens with foreign currencies and commodity prices and spreads. Operational risk, on the other hand, is the possibility of loss resulting from failed internal processes. I had a really good professor when I was working on my master's degree who defined operational risk as the variability in operating income. What's operating income? That's revenues minus expenses, operating revenues minus operating expenses that have to do with the core function of the business or the financial institution. And so a failed internal process, notice in the definition there, systems or people. And it also could be the result of some external event. But the point is that, what are we hoping to do? We're hoping to make something for pennies and sell it for dollars. And that's no different within a financial institution. And so that operational risk is the risk of generating fewer revenues than expected and having greater expenses than expected. Liquidity risk. Remember, liquidity is the ability to turn an asset into cash quickly so that you can meet some type of short-term obligation or be able to be responsive to some kind of a liquidity event. And so notice the definition reads something like a lack of a ready market for investment. And so think about that market risk up there. We have all these stocks and bonds and fixed income securities and commodities in which we have invested as the financial institution. And if we need to sell those things, what we want to do is be able to go to the floor of the New York Stock Exchange. We want to be able to go to the commodity exchange and sell those at a fair price. Of course, what happens to liquidity? Liquidity tends to dry up during times of financial crises, and nobody really wants to buy your stock or your bond or your commodity unless you offer it to them at quite a discount. And then reputational risk is a loss in reputational capital based on either real or perceived. And this is important, perceived losses. Financial institutions have, they have these reputations. A lot of these financial institutions, they have names that sound like, the Rock of Gibraltar, so that if you invest in Jim's Rock of Gibraltar financial institution, what does that sound like? I'm solid. I've been there for, how long has that rock been over there? I don't know, thousands of years, millions of years. Anyway, the point is that no matter how the waves crash in, I'm going to be around. Now, of course, this reputation depends on the decisions made by the men and women who are in charge of running this financial institution. And so if that reputational capital takes a hit, well, then there's going to be a loss. How about the difference between economic and regulatory capital? So economic capital is exactly what you learned back in your undergraduate finance and accounting and economics days, and probably through your graduate school as well. It's the amount of capital that a bank needs in order to remain solvent and be able to maintain its day-to-day operations, which means that it can meet its short-term obligations and any long-term obligations that are coming due. Some people refer to it as risk capital because it's the amount of capital required to absorb the impact of these unexpected losses. Go back 10 years to the 2008 financial crisis. How much capital was required to remain solvent during that time period. And this is as opposed to regulatory capital. The regulatory capital is the amount a bank required in order to meet the government regulations and the rules and the guidance and the laws. And of course, we're subject to the Basel II, which separates this into the Tier 1 capital, the Tier 2 capital, and the Tier 3 capital. So just distinguish between these two by remembering that regulatory capital has everything to do with whatever the government body says that the financial institutions are required to have. Economic capital, though, is going back to your undergraduate, just basic accounting and economic days. How much do we need laying around so that I can meet all the people who are knocking on my door saying that I owe them money? Now, of course, if banks are subject to demand for the deposits that individuals and institutions have made with them over time, the bank then has to pay them. That's a liability, right? If I deposit money into a bank, it's my money. If I want it back, I can go get it. Well, in almost every developed country, the government has a guarantee that if a bank goes through some kind of insolvency or bankruptcy or failure, then the bank's depositors are insured. This is called deposit insurance. In the United States, the FDIC was created sometime in the 30s as a result of not only the stock market crash of 1929, but then all the stuff that happened after that. Didn't we call that a depression? So in the United States these days, the insurance goes up to $250,000 of deposits. Not all the other stuff that you can do with a bank, but deposits. And in the UK, it's £85,000. Now, the problem is that if I deposit $250,000 in my local bank, I know that no matter what happens to the bank, that the federal government's going to step in and pay me my $250,000. Therefore, I really don't care what the bank does with my money. This is called a moral hazard because the bank knows that I don't care what it does with my money, and it knows that the federal government is going to step in and compensate me for any losses, and so they're going to probably be tempted to make decisions that are not risk-based. So notice what I have in that last arrow point there. This lack of scrutiny means that banks are free to lend as much as they want to whomever they wish, besides investing in other income-generating assets of their choice. Now, that might be a little bit extreme as a bullet point, but nevertheless, I mean, there's a problem with moral hazard and deposit insurance. How about the different investment banking arrangements here? And so what the investment banking wing of a financial institution does is that they help raise capital for corporations and businesses and governments. And remember, swinging back to that one liquidity issue that we talked about, the reason that this is so popular is because financial corporations and governments can raise capital quickly, right? I mean, especially for corporations. Why do they issue debt and equity? Because they have a positive net present value project in which to invest, right? So they want their money today. They want it quickly before a competitor comes in and does the same thing. All right, so there are 3 steps here. Typical arrangement starts with a corporation approaching an investment bank and says, hey, I need $500 million because I have this great idea for a product line that, boy, it's going to sell. All right, so then the 2 groups of people, the business and the investment bank, they get together. Remember, the investment banker, these are all experts. You guys are studying to become these experts, along with lots of other finance and accounting and economics professionals. So they decide, are we going to issue debt? Are we going to issue equity? What does that mean for the capital structure of the firm? Let me throw something out there to you guys who know this. Let's go back to 1958 and the Modigliani and Miller theory on optimal capital structure. That's really cool stuff. And then, of course, what happens is that the corporation then gives the financial institution the right to go out and raise money however they want or however it's decided on. Okay, so what then that means is that the investment banking firm can then raise the capital quickly, provide that to the corporation. The corporation has the capital, then can go out and make that investment in their product line. And then those securities then are sold in this, that's called the primary market. Now, how exactly is the process of selling these securities to the public? It takes a couple of different forms. Private placement, the securities are sold to a small number of chosen investors. It's not really available to the general public. What tends to happen is these privately placed securities are placed with institutions like endowment funds or pension funds who probably have the idea that they're going to hold on to these securities until they mature, if they're fixed income securities or if they're equity securities for a long time. One of the most famous privately placed securities goes back about 20 years. I think the year was 1997, maybe it was 1996. You guys know I love to give sports analogies. I love to give analogies for my family. But let me give a rock and roll analogy here. There was this great rock and roller named David Bowie who wanted to create his own recording studio, and he wanted someone to help him pay for it. Plus, this was on the cusp of, the explosion of the internet, and I'm not even sure if that company, Napster, that online trading company, I don't even know if they were doing this, but David Bowie was aware. You go back and look at a quote. He was saying things like, in 10 years, music is going to be free. So the combination of these 2 things led him to approach, he had an agent, and they went to an investment banking firm, and they decided to securitize his future record sales based on all of his old time music, some of those great rock and roll songs, The Young American, wow. And so what happened is that this investment banking firm, they sold this to Prudential Securities, $55 million. So David Bowie got his money almost immediately. And then the bondholders, they were going to receive, I believe the coupon rate was 7.9% or maybe 8.1%. It was a 10-year bond, and these were kind of self-liquidating or self-retiring. So they were kind of amortized in a sense. But I'm pretty sure that Prudential held on to these into maturity. They may have privately placed them into some others. Fascinating thing about this is that Moody's assigned, I think it was a single A rating, so it was an investment graded rating. And then after the whole Napster thing hit in 2000 or whatever that hit, they downgraded these bonds to maybe single B or maybe even lower. But the cool thing about this private placement is that Prudential and these other investors, if there were any, they held them to maturity. So they got their 7.9% over 10 years, and then they got the return of principal. Cool stuff. Public offerings, these get most of the attention if you're regular readers of the Wall Street Journal. And so we can offer these equity or fixed income securities to the public. And the way this works is the following. There are generally two ways. What the investment banking firm can do is they can say, you know what, I'm going to do my best to sell these securities at the highest price possible. And if you want me to sell 10 million securities, I'm going to do my best to sell 10 million. But if I only sell 9 million, I'm going to return the 1 million to you. That's called the best effort. And the financial institution just receives a flat fee for that. But most of these are firm commitment, where the investment banker takes the underwriting risk, the underwriting function, and they say, look, you need $500 million. Here's $500 million. We'll give it to you today, and we're going to sell these to the investing public, and maybe we'll get $510 million for them. How about my favorite thing here, a Dutch auction? Now, I've written a bunch of academically published journal articles over the years, but my favorite one was on a Dutch auction repurchase. So what firms can do is they can repurchase their shares by a Dutch auction. What they do is they offer a range of prices, like $45 to $52 per share. But the flip side of this is when companies want to raise money, they can do a Dutch auction initial public offering. All right, so what happens here is that the price of the offering is set, taking into consideration all bids to determine that higher price. So what a firm does during the IPO, and by the way, Google did this several years ago, maybe about 5 years ago. What happens is that the firm says, look, we'll sell you our shares, and we'll sell them in a range from, let me just pick that same number. What did I say? 45 to 52. And what the investors get to do is they get to pick the number of shares that they want to buy, and they get to pick the price at which they want to buy. Now, the Dutch auction uniqueness about this means that all investors will pay the same price. So what happens is that investors, they're all going to bid different amounts, right? So someone might bid 1,000 shares, someone might bid 10,000 shares, some institution might bid 10 million shares. But when it's all said and done, what happens is that every investor pays the same price. So let's work through an example here. Let's suppose that we have a company that wants to sell 10 million shares in a Dutch auction. All right, so what they're going to do is they're going to say something like, hey, we'll start at $50 a share. So what happens here is that the investors then, they can make bids. So someone might say, hey, you know what? I'll pay the most. I'll pay the $50 per share because I really love this company and I really want to get in as part of the ownership of this company. And then other investors, they're going to bid something less. So notice there are 2 bids at 48, 1 bid at 47, and so on, all the way down to 5 bids at 42. So what those shareholders are doing in bidding the $42, they're saying, well, of course, I want to pay the least amount to participate in this public offering, and I'm going to bid $42. So notice that there's a trade-off here. If you bid the $50, you're probably very likely going to participate in the auction. If you bid $42, you might get left out of the auction. So this is a classic marginal cost and marginal benefit trade-off. And so you might think that investors would all get together and they would all say, you know what, let's all bid $42. And so we can pay the least amount for this initial public offering. And that's going to work great. If everyone agrees and everyone goes ahead and bids $42, then all investors will pay $42, right? But there's got to be a clever investor out there who says, you know what, if everyone else is going to bid 42, I'm going to go ahead and bid $42.01. And therefore, all those people down there, they might get left out, but I'm going to be a participant in this auction, because remember, the firm wants to raise as much money as possible. So let me go ahead and hit the next slide here. So what happens is that what the firm will do is that it will start with the $50 and then move its way down and move its way down. And so notice that on the far right side, the cumulative shares, there's that 10 million shares. So they get their 10 million shares and they do it at $45. So everybody gets $45, but notice the $44 and the $42 people, they are left out. Now the cool thing about this is that what it does, this Dutch auction IPO and the Dutch auction share repurchase, if companies do this together, it gives them an interesting information about the supply and the demand curves for their shares. And they can use this information for future repurchases and future seasoned equity offerings to make a more accurate timing and a more accurate determination on price. Of course, going back to your economics days, elasticities of demand and all that kind of good stuff. Just remember, the Dutch auction allows investors to pick the number of shares and pick their price, but everybody gets the same price in the end. What else does a financial institution do inside of these financing arrangements? Of course, they have advisory services and then securities trading. Those are pretty self-explanatory. How about conflicts of interests in the financial institutions industry? Oh my gosh, think about this. A bank might be tempted to recommend the securities being sold by its investment banking wing. So think about the investment bankers, the underwriters over here. They're using a firm commitment to raise capital for this company. And then over here, you've got the traders, and they're going to recommend to all their investors, hey, this is a great security. Let's buy it. So they're making money on this side. They're making money on this side. That's why lots of professional organizations establish an ethical wall between the two wings of financial institutions. Let's move down the list here. Research division may mark a share as a buy just to impress management and create business. There's also an incentive to suggest one of its corporate borrowers may default. The bank may be tempted to push for flotation of a bond, maybe too aggressively, so that the loan can then be paid off. Bank may also be tempted to pass information on the borrower to help it provide advice to potential acquiring firms. So there are all sorts of potential and real conflicts of interest in banking. That's why lots of these designations out there have an emphasis on ethics. And here's the thing here. So we need to have a firewall in order to avoid conflicts of interest and potential conflicts of interest. And the word some banks shouldn't be in there. I mean, all banks should have a formal information barrier where people over here on the right don't know what the people over here on the left are doing, so that they both make sound, fundamental economic and financial risk management decisions. How about distinguishing between the banking book and the trading book? So the banking book consists of assets on the bank's balance sheet that are expected to be held to maturity. So they identify these securities like the David Bowie bonds. We're going to hold these things to maturity. So we're going to receive the interest payment, we're going to receive the principal payment, and then when the bond matures, we're going to be happy about it all. Now, the interesting thing about this is that the bank can carry those. Of course, the bank is going to carry these on its records, but they're going to record them at fair value. They're going to use historical cost accounting. But the bank does not have to mark these assets to market on a daily basis or on a weekly basis or on a monthly basis. And so the value at risk, best practice, is to do this over a 1-year time horizon using a pretty high confidence interval. Confidence level. Now, the trading book means exactly what it suggests. These are assets that are available for sale, meaning that they are eligible for trading every day. In other words, if someone's going to come to you and says, hey, I see you have that fixed income security there, I'll pay you a certain amount of money, then you're going to sell it to them as the financial institution. And so these financial securities have to be marked to market on a daily basis. And then the value at risk sometimes is done on even a daily basis, maybe a weekly basis. But of course, the best practice is to do it over a 10-day time horizon. Now, historically, banks used to originate loans and keep them on their balance sheet until maturity. Here's the example that I give my students all the time. Let's suppose that we grant 30-year mortgage loans. So what do we have to do? We have to go knock on that door every month for 30 years and say, where's my interest and where's my principal? Originate to hold model. So this is a long process to generate income and to get your money back as a financial institution. Now, over time, banks gradually and increasingly began to distribute the loans. So there's the mortgage borrower, there's the financial institution, there's the bank, and there's this special purpose entity or a special purpose vehicle where you can put these loans and then you can sell them or you can do whatever you want with them. What this does is notice I have in the bold there, limits the growth of the balance sheet. Now, it introduces specialization in the lending process. The functions that were initially designated for a single firm can now be split among several firms. And it reduces the bank's reliance on those traditional sources of capital like deposits. It also allows firms to diversify. Now, disadvantages include relaxation of lending standards and contributes to riskier lender. Also makes it more difficult for borrowers to renegotiate. And the assets that are retained on the balance sheet become increasingly less representative of the role they play in the process of extending credit. Notice I have the word obscured bolded down there on the bottom right. And that takes us through our first chapter.